There are mistakes, there are bad decisions, and then there are signatures that change history forever. This is the story of one man, one document, one penstroke, that destroyed more wealth than the GDP of entire nations. No war, no invasion, no revolution, just a signature. Welcome to Finance Unmasked. In the early 2000s, this man was untouchable. He controlled markets, he controlled governments, and for a brief moment, he controlled the global financial system. His net worth was so large that comparing it to millionaires was meaningless. He wasn't competing with people, he was competing with countries. And then, one signature erased it all. Before the collapse, he was celebrated as a genius. Business magazines called him visionary, financial architect, the man who redefined risk. Politicians invited him to private dinners. Central bankers returned his calls instantly. Regulators trusted his word. Why? Because his company wasn't just big, it was systemically important, meaning, if it failed, the world would feel it. And that belief, that he was too important to fail, is exactly what destroyed him. His firm didn't manufacture products, didn't mine gold, didn't drill oil. It traded risk. Insurance on bonds, insurance on mortgages, insurance on financial instruments most people didn't even understand. On paper it looked brilliant. Low probability events, tiny premiums, massive volume, collect small money from everyone, forever or so he believed. At its peak, his company insured trillions of dollars worth of assets, not millions, not billions, trillions. That's larger than the annual GDP of India, the UK, France, combined. Here's the dangerous part. The risk looked invisible because nothing had gone wrong, yet housing prices kept rising, defaults stayed low, cash kept flowing in. Every quarter reinforced the same lie: we're safe. And when analysts asked questions, he signed documents saying risk models were solid, exposure was controlled, capital was sufficient. Those signatures reassured banks, governments, pension funds, entire nations, but the models were wrong, fatally wrong. Then came one request, a demand from regulators, a demand from counterparties. They wanted more collateral, just a signature acknowledging responsibility if things went bad. On the surface, it looked routine, legal paperwork, standard compliance. He hesitated, because deep down, he knew that signature meant, if the system breaks, I pay. And still, he signed. That penstroke did three things instantly. It turned theoretical risk into legal obligation. It exposed the firm's real balance sheet. It triggered clauses written years earlier. Clauses no one paid attention to. Clauses that said, if confidence drops, collateral requirements explode. And confidence is fragile. Housing prices stalled, not crashed, just stopped rising. That was enough. Ratings agencies downgraded assets. Margin calls began. Billions demanded overnight. Cash that didn't exist. And suddenly, the company that insured the world needed insurance itself. Within weeks, $20 billion demanded, then $40 billion, then $80 billion. Each call larger than the last. No time, no liquidity. And because of that signature, there was no legal escape. Governments stepped in, not because they liked him, but because, if he fell, banks would fall, pensions would collapse, currencies would shake. The damage wasn't personal anymore, it was global. One signature had connected his fate to the fate of the world. Once the collapse started, there was no stopping it, because this wasn't just a company failing. This was the plumbing of the global financial system breaking apart, and everyone was connected to it. The night the phone never stopped ringing. Inside government buildings, phones rang through the night. Treasury officials, central bankers, presidents, everyone asking the same question: what happens if this company fails? And the answer terrified them, because this firm wasn't holding risk. It had absorbed risk from the entire world. Banks had used its guarantees to lend more. Funds had used its guarantees to leverage more. Governments had trusted its guarantees to stay stable. If the guarantees vanished, everything unraveled. The number that changed everything. By the time regulators understood the real exposure, the number on the table wasn't billions. It wasn't even hundreds of billions. It was over $2 trillion. That's not a typo. $2 trillion of obligations. To put that in perspective, larger than the GDP of Canada at the time, larger than the GDP of South Korea, larger than most countries on Earth. All tied to one company. All triggered by one signature. No private institution could absorb that loss. Not even close. Why the government had no choice. People still ask, why didn't they let it fail? Here's the brutal truth. If they had, major banks would have collapsed within days. Pension funds would have vaporized. Insurance companies would have gone insolvent. Global trade would have frozen. ATMs wouldn't have worked. Payrolls wouldn't have cleared. Credit cards would have stopped. This wasn't capitalism anymore. This was damage control. The largest bailout in history. So the government stepped in, quietly at first. Then publicly, they injected money, then more money, then control. In the end, taxpayers committed over $180 billion directly, and indirectly, much more. The firm was effectively nationalized. Private profits had been kept for years, but losses, socialized. And the man who signed, he lost everything, the personal cost. At his peak, his net worth was estimated in the tens of billions. After the collapse, near zero, no company, no power, no influence, from global decision-maker to historical footnote. But here's the part most people miss. This wasn't just his failure. Yes, his signature triggered it, but the system allowed it. Because everyone believed the same lie. Someone else is managing the risk. Banks believed ratings agencies. Ratings agencies believed models. Models believed housing would never fall. And governments believed someone smarter was watching. No one was. Why this story matters today? Because this exact structure still exists. Different names, different instruments, same logic. Risk bundled, leverage hidden, confidence assumed, and signatures still being signed. The lesson isn't don't trust finance. The lesson is darker. The real lesson, complex systems fail quietly, until they fail all at once. The most dangerous risks don't look dangerous, don't make noise, don't trigger fear, until the moment they do. And when they break faster than anyone expects. The final truth. That single signature didn't just cost him his fortune. It reshaped global finance, it rewrote regulations, it changed how risk is measured. It taught governments one terrifying rule. Some failures are too large to allow, but that rule comes with a price, and that price is paid by everyone. Because when private risk becomes public loss, the system survives. But trust never fully recovers. Empires don't fall from invasions anymore. They fall from paperwork, from assumptions, from signatures no one reads carefully enough. And history keeps proving the same thing. The most expensive decisions are often made in silence. If this story changed how you see money, power, and risk, subscribe, because the next signature is already being written.